Hey guys, Ken Boyd at Accounting Accidentally. This is a new video called Crowdstrike, Stock Dividends, and Measuring Shareholder Returns. Remember, the content that you're watching here you can find in my new book, my fifth book, How to Manage Personal Finances. You can find all the content for the book here on the Accounting Accidentally Substack page, and you can also find a YouTube playlist with all the videos from the book, including the content that you're watching now. You can email me at ken@stltest.net. If you'd like information on the book, it will be out in 2025. So most of us have heard about the Crowdstrike technical issue with the airlines that we had here in late July of 2024. I happened to be traveling on vacation. Fortunately, I was on Southwest, which did not experience this problem. The problem was related to an upgrade in Microsoft. American, Delta, and all kinds of airlines couldn't communicate. They canceled thousands of flights, and you can see here that the Delta CEO said that the CrowdStrike tech outage cost $500 million. A huge issue. Thousands of people, tens of thousands of people were affected. Now that we talked about the airline issue, let's talk about value and how you value an airline. You value an airline based on, can they get you where they need to go safely at a reasonable price? Well, what CrowdStrike tells you is, if all airlines, let's exclude Southwest, if all airlines are having a technical issue and none of them can get you where you need to go on time, regardless of the price you paid, what are these companies really worth in your mind if you can't travel based on a computer outage, which is what we had here? I think it's an interesting way to look at value, and it also lets us do a transition into value when it comes to common stock. Measure the value of a cash dividend. Dividend yield is a term that reports the rate of return of a dividend based on the current market price of the stock. The formula is the annual dividend per share divided by the market price. So for example, Premier, an example company, pays a 125 dividend when the stock price is at 60. 125 divided by 60 is 2.1% with rounding. So the way to think about it is, as an investor, if you purchase Premier at $60 a share, one of the things you're buying, one of the values you're buying, is a 2.1% dividend return. Now, a dividend payout ratio points out the percentage of company earnings paid as a dividend, because remember, a company does not have to pay a dividend with earnings. And even if they do have earnings, they do not have to pay a dividend with all the earnings. So with that in mind, the dividend payout ratio, common stock dividend divided by earnings available for common shareholder. The payout ratio in this case is $1.25. Let's assume the earnings per share is $2.50. 50% of the earnings are paid out as a dividend. A larger, more stable company with predictable earnings is going to pay out a bigger percentage as a dividend. So that being said, let's compute the shareholder return on a stock. The increase in the common stock price, stock can go up in price, plus the annual dividend per share divided by the common stock share price. At the beginning of the period, we're going to say it's a year. So to calculate the return, we assume these facts to do this calculation. Premier stock price increases $2 per share within the year. The stock pays $1.25 dividend, and the beginning stock price is $60 a share. So the annual shareholder return is $2 stock price increase, $1.25 dividend, add those together, divided by 60 beginning stock price, 5.4%. So that's what we have earned. That is the value that we've earned on the stock during the year. But there's a third benefit from owning the stock that's not included in the formula, and that's a stock dividend. So let's assume that Premier pays a 10% stock dividend and that our investor Sally owns 100 shares. So Sally gets 100 shares times 10%, or 10 more shares. And this is the key, that's 10 more shares that can increase in price, earn a dividend, or both. So the moral of the story here is stock dividend is another way to benefit from owning stock and keeping it. So the takeaways here are, there's three ways to benefit from owning common stock. The price goes up, earning a dividend, but also stock dividends. So the moral of the story here is, remember that the possibility of getting a stock dividend gives you another opportunity to both have an increase in the stock price and earn a dividend. So don't forget about the value of stock dividends.